Hello, and welcome to the virtual convening series hosted by the Sorenson Impact Institute. We are excited to have you all here with us as we learn more about bridging the affordable housing gap with impact real estate. My name is Alan Lowe, Manager of Impact Finance at the Sorenson Impact Institute. The Sorenson Impact Institute connects capital to impact through innovative finance structuring, impact measurement, impact strategy, and human-centered storytelling. We are proudly housed at the University of Utah's David Eccles School of Business, where we also help to train future leaders in impact. Today, I'm joined by our speakers, Kate Murray, Director of Impact Strategy and Measurement at TAS, and Jeremy Keele, co-founder and managing partner of Catalyst Opportunity Fund, both seasoned experts in impact real estate. The goal of our conversation today is to take a deep dive into the current state of affordable housing crisis, learn about some of the most comprehensive, rigorous approaches to impact management practice in real estate, and explore impact fund structures to achieve real estate goals, as demonstrated by the Institute's ongoing collaboration with TAS. I will now invite our speakers to introduce themselves. Kate, would you like to go first?
Thank you. Thank you so much for the opportunity to be here. My name is Kate Murray. As Alan mentioned, I'm the Director of Impact Strategy and Measurement with TAS. I've been working in impact investment for over a decade now and have been specifically with TAS for 3 years, where I was involved in developing our impact framework and our approach to impact strategy, measurement, and management. And thank you again for the opportunity to be here today.
Thanks, Alan. Good to be with you. Good to be with Kate as well. My name is Jeremy Keele. I run a private equity strategy called Catalyst, and we focus on addressing the affordability crisis in the country. We also focus on bringing sort of services and amenities into underrepresented communities. And so it's a pleasure to be here and excited for the conversation. Thanks for having me.
Thank you both. Jeremy, you've spoken in multiple settings about the housing affordability crisis being one of the defining issues of our time. I'd love to hear from both of you on why you think that is.
Yeah, I'm happy to go first. I think that's probably not overstating it to say that this is one of the defining issues of our time. I'm a bit of a data geek, so I'd love to kind of give this conversation some context by talking about a few, high-level statistics that really frame out the affordability crisis, I think. So I'll do that, and then I'll talk about kind of like what I think are the real world implications of all of this. I want to say too that this is, I think, a fairly recent crisis and has kind of snuck up on us in a way. Similar, I think, to kind of the climate change discourse and some of the issues that you're seeing there. It's something that's sort of surprising and shocking in how sweeping the problem is, and also just how, again, recently it's hit us. When I started Catalyst 5 years ago, the notion of lack of affordability was something that you thought about in big kind of coastal gateway markets like New York and San Francisco. But in places like Salt Lake City, where I live, or Nashville, or Austin, or some of these kind of secondary markets, it was not the big issue in those communities. And I can tell you that in those 5 years, really across the board in every community, certainly that I travel in around the country, in every community that we're investing in at Catalyst, this has become, arguably the top sort of policy issue for local government officials, for local communities, the top complaint of kind of the average person on the street. So this is again a recent problem, but a big problem. We've just hit a sad milestone in this country. 49%, so effectively half of the country is what is now called rent burdened or cost burdened by housing. And what that effectively means is HUD actually has at the federal level some definitions and standards around this. But what that effectively means is that people are paying more than 30% of their gross income to housing, whether that's rent or mortgage payments. So that's a threshold. It's a scary threshold. It's a threshold at which you're starting to make sacrifices and trade-offs in your personal finances that can lead to, I think, bad outcomes. The other sort of related and also sad milestone is that something like 50% of those cost-burdened households are what are called severely cost-burdened, which means they're spending more than 50% of their income on rent. So the basic problem we have in the country is that rents have gone up dramatically. And we'll talk about mortgage interest payments as well, because there's obviously a parallel conversation there. But just talking about rents have gone up dramatically, in particular in recent years in most of these communities, whereas wages have not gone up nearly as much. And so, in fact, it's a 4-to-1 ratio. So since 1985, rents have outpaced incomes in terms of growth by a factor of 4-to-1. So it's sort of an unsustainable kind of macro trend or dynamic built into the problem here. And by the way, that's an average stat across the country. When you look at higher growth markets that have been, especially in recent years, seeing something like 20 to 30% year-on-year rent growth, like literally 20 to 30% year-on-year growth in rents, resulting in something like a doubling of rents every 3 to 4 years. This has been happening in some markets for the last 5 to 10 years. It's just become unsustainable. On the kind of home ownership side, again, there's sort of a parallel conversation there. With interest rates going up the way they have in the last 18 months or so, you now have in the country 17 million households that would be potential home buyers that are now effectively priced out of the home buying market. And that really pushes those folks into kind of the renter class that they otherwise wouldn't be in. So the high interest rates are also kind of playing a role in all this. There is, I should emphasize, there is plenty of demand for attainable housing and affordable housing in the country. This is really a supply side constraint issue. And if you think about existing supply, there is what's called naturally occurring affordable housing out there in the country, places that, because of where they sit or because of the condition of the unit or whatever it is, are sort of affordable by, just by virtue of what they are. A lot of that supply, unfortunately, in recent years has been bought up. And this is a kind of a narrative and a theme in the press recently, has been bought up by investors, mom and pop investors, all the way up to very institutional groups and asset management groups. And that housing stock has been improved and effectively turned over, and they've raised the rents on those units. So a lot of that naturally occurring affordable housing stock that we did have in this country has been replaced with non-affordable housing stock, and that's an issue. On the new supply side, this is even a bigger problem, because you have a really unique set of constraints on the growth of new supply in the market right now. One is interest rates, again, to sort of finance the development and the creation of ground up, multifamily projects, affordable housing projects, et cetera, that can sort of, put a dent in the supply deficit that we have in the country. But then you've also had, since the pandemic started a few years ago, really, really high construction costs, something like 40% higher construction costs than we had in the decade prior to the pandemic. So really nasty combination of high interest rates to finance new projects, coupled with high construction costs, means that effectively there's very little supply that's hitting the market. Now, you might say, actually, I live in Salt Lake or I live in Austin, and I see a lot of new supply coming in. The fact of the matter is that new supply is by and large luxury product, because luxury product is effectively the only housing product that's penciling from a development perspective right now. And in fact, Harvard has a joint center on housing studies. They put out a stat recently suggesting that something like 9 out of 10 new housing units in the country that are being delivered are built for that luxury market. So there's a huge sort of supply deficit for the kind of workforce attainable or affordable demographic. The new, and then there's also just a general new supply cliff that we're facing right now, which is with these higher interest rates that have just come into effect in the last few months or year. All supply has really kind of dropped off a cliff. We saw a 38% decrease in the number of new multifamily starts in 2023 relative to 2022. So developers just not able to make these projects pencil anymore. So that at a high level, using some data that's hopefully helpful, gives you a sense of kind of what the problem looks like at kind of a macro level in the country. And I'm glad we have Kate on, because I think it'll be interesting to get her perspective on what's happening in Canada, where she works. But what I want to do is just spend one quick minute talking about kind of the manifestations of the housing crisis and kind of what does that actually mean in these communities that we're talking about. I think a lot of the folks on the webinar, myself included, aren't worrying day to day about, how I'm going to put food on the table, and therefore I can absorb, housing cost increases in a way that other folks can't. But I think it's helpful to understand what this means in practice. What it means in practice for a lot of folks is a cash crunch, where they're effectively being forced to make trade-offs and sacrifice other priorities within the kind of family or household budget. When you think about investing in education or nutritious sort of food options, retirement savings, wealth building, et cetera, all of those things come off the table when so much of your income is going right to your rent. We did a needs assessment in a community where we're investing, and I'll tell you more about our community needs assessment in just a minute. But one of the things that we looked at was sort of the average net worth of residents of that community. And it's a low income community, but we were absolutely shocked to find that the average net worth in that community was about $11,000. So these are folks that are sort of literally not getting ahead, barely treading water to kind of make ends meet, and certainly not sort of putting money away for retirement or creating wealth. That also introduces a really profound kind of toxic stress component into their lives that I would argue, and I think there's research to suggest to back this up, that I would argue impacts their career because this stress bleeds into their career. This impacts their family, their kind of home life, how they parent their kids, et cetera, and their health, their behavioral and their physical health. And if you look at healthcare, there's a big focus on what are called the social determinants of health, meaning the things that are happening in the community that drive real healthcare outcomes in doctors' offices, in hospitals. Housing is top of that list, and it really does have a big impact on health. Last thing I'll say in this is that there's a really fantastic piece of research that's just come out by the University of California, San Francisco, and it's sort of the most comprehensive study that's been done on homelessness. It's in the state of California. Massive data set, thousands of interviews, and what they found when they did that study is that the primary driver of homelessness, not surprisingly perhaps, is the cost of housing. And yes, there are sort of confounding variables and contributing variables, mental health issues, substance use issues, but really those are just sort of ancillary to the primary problem, which is cost of housing. So this is something that I think we've got to get as a society, got to get our head wrapped around and really address.
Thank you for sharing, Jeremy. Kate would also love to hear your thoughts on this.
Yeah, thank you so much for that framing, Jeremy. I think you did a really wonderful job explaining the context in which we're operating, but also diving into the lived experience of housing stress. I think, identifying the true cost of housing stress is really, really essential to these conversations, and never losing sight of that. I have a few comments to make on the Canadian context. It's very similar to what you described, Jeremy, so I won't go in as much detail. However, we operate largely in the Toronto market, and in Toronto, home buyers need an annual income of $217,000 in order to afford to buy the average home, which in the Toronto region is now over $1 million. And yes, we are talking about Canadian dollars, so there's a bit of a discount there. But I can tell you that $217,000 is substantially above average household incomes in this city and country. So about 40% of people in Toronto are spending more than 30% of their income on rent. And the supply of rental housing is increasing, but it isn't happening fast enough to offset this demand. Currently, vacancy rates in Toronto are about 1.7%. So the market is is very competitive. Average rent for new supply entering the market is actually about 45% higher than average rent for all units. So the average listing price for a one-bedroom unit in Toronto is almost $2,500 now. And it isn't just a problem that we're seeing in the major cities like Toronto, Montreal, or Vancouver. We're seeing these affordability challenges across the country, much as Jeremy described is happening in the US. So the CMHC, or the known as the Canadian Mortgage and Housing Corporation, estimates that in Canada we need to build about 3.5 million more homes by 2030. And that is over and above the current rate of construction in order to restore housing affordability for Canadians. So that means almost 1.5 million units in Ontario alone. And I think that the dual priorities of decarbonization and housing affordability are like the major challenges of our time in the real estate sector, certainly. So the current environment is actually threatening our ability to fill that gap. We have very high interest rates in our country as well, actually a bit, typically a little bit higher than what's set in the US. Similarly, escalating construction costs, and we also have downward pressure on values, which has reduced the available capital to real estate development. And as a result, many of the shovel-ready sites have been put on pause because they lack the upfront equity they need to start construction right now. So projects that include affordable housing are even more likely to get stalled in this environment. In order to make projects financially viable in the current environment, developers have had to set rental rates high enough to cover their costs and to meet return thresholds that lenders and investors require in order to meet in order to secure the equity and debt that they need to get projects built. So we're in a bit of a crunch here in this country to start building to meet these demands, and at the same time make the project stack in order to get them out of the ground.
Thank you for sharing the information with us. It seems that there are many similarities between the US and Canadian markets, but there are also some notable local differences at the same time. I'm also interested to learn about the solutions you've each worked towards, and how did you decide on a strategy for your efforts? Kate, why don't we start with you?
Certainly. So I've actually been with TAS for a little over 3 years now, and have worked very closely with the business first to develop our impact framework, which helps us to define our strategy and deploy capital in terms of making meaningful positive impact in the world. And so we employed a double materiality lens to identifying our commitments. And the first is actually a corporate commitment. It's called It Starts With Us. And what I noticed sitting on the other side of the table, actually often as an investor or advisor, was that many strategies would focus on the product or service impact that would be delivered through an investment strategy, but wouldn't look at the actual operations of the manager themselves. And so we shine a mirror, hold up a mirror to ourselves, and look at every single way that we can create an impact through diversity, equity, inclusion, social procurement programs. We are a B Corp and have been for about a decade. And so we look at every single opportunity that we have to generate positive impact through the operations of our business itself. We then identified 3 project delivery commitments that were core to our strategy. So the first is tackling climate change, which is broadly our environmental approach to reducing the harm of the built environment. Broadening affordability and equity. We have both a commercial real estate strategy and affordable residential strategies seeking to address some of these challenges that we've just contextualized. And then finally, building social capital, in which we seek to engage deeply with community and help to foster vibrant places that support resiliency within the communities in which we operate. And so we have several partnerships, for example, with the Toronto Foundation, supporting them in their research around social capital, capital and levels of connectedness, trust, resilience within communities across the country. And we use the insights from that to actually embed into our own approaches to creating social infrastructure where we operate. And so this framework was actually the underpinnings of our collaboration with the Sorenson Institute as well. And we have collaborated very, very closely in developing our impact measurement and management system at TAS. And we're really excited about this and the way that it'll help to embed our strategy into day-to-day operations and align everything from capital right down to bricks and mortar on the ground, and ultimately to measure outcomes at the end of the day. And so our measurement system, we actually identified 18 strategic activities across those 4 commitments, and each of those strategic activities identify a specific focus area for our team to help to execute on the strategies. So, within tackling climate change, we look at our embodied and operating carbon. We look at the supply chain impact across numerous environmental and social issues. We have a strategy around affordability and equity building in our commercial and residential real estate, and look at community infrastructure, community development, placemaking, and other initiatives that we can approach. And every single strategic activity has its own measurement assigned to it. And we worked very, very closely with Sorenson to go through line by line and ensure that the measurement system that we're developing aligned to industry best practice, was grounded in scientific research in terms of any targets that were set, and that the theory of change that we established was evidence-based, in that there was evidence in the research and prior case studies that our approach that we had documented should lead to the outcomes we ultimately want to achieve. And it's just something that I think is really important about our approach, and that Sorenson helped us to develop, was that we look at both the way in which the business can effectuate change, so that is our theory of change, but also beneficiary outcomes at the end of the day. And so what ultimately we care about is what changes for the community members that we're working with, and what improves. And so we have an entire section of the measurement system designed to capture feedback from the community. We have both closed and open-ended questions to help us understand what their lived experience is. And so that's a big part of our approach and our strategy. And we're now working closely with Sorenson Impact Institute again to see how we can leverage the insights and knowledge and the evidence that we can, the evidence-based approach that we can generate from a measurement system to align capital and capital structures with the ultimate outcomes that have been identified by community.
Thank you, Kate. We enjoyed our collaboration with you, especially the deep community approach that your team has in solving the issues currently happening in Canada. Jeremy, could you also share your team's approach on this?
Yeah, for sure. And it was great to see Kate, walk through their strategy and their framework, and it's really thoughtful. And maybe I'll just spend a minute on kind of the investment strategy, because I think, I was all doom and gloom a minute ago, but I think there are some interesting innovations and solutions out there that we're on top of, and that, other groups are as well, that, offer some rays of hope in all of this. But, I guess just to differentiate the strategies a little bit, or at least our strategy from others out there, we're really focused on ground up development. Our goal is to sort of chip, on the affordable housing side at least, to chip away at something like a 5.5 million unit supply deficit in this country. So again, preservation strategies are great. You're never going to chip away at that supply deficit unless you're building new construction. So with the current funds that we have invested, that's really been the focus. And you have, as I said a minute ago, a lot of supply that's recently hit the market for kind of the luxury end of the spectrum. You also have, I think, some interesting kind of tools in the toolbox at the federal government level to supply deeply affordable housing. But what you don't have in the U.S., at least, is sort of a set of tools or toolbox that can help you invest in and deliver housing for the missing middle, as it's often referred to. We call this kind of the essential workforce in a community. These are the cops and the nurses and the teachers, grocery store clerks, et cetera, folks that have jobs, but that increasingly can't afford to live in their own communities, and certainly not live and work in the same community in a lot of cases. So that's really been our focus, is kind of targeting that workforce demographic. The other thing I would just say is that, redlining is a term that people are familiar with here in the States. Institutional redlining, thank goodness, no longer exists, but I would argue that there is a legacy of redlining that's still that we still live with in the capital markets, which is to say that there's a lot of pools of capital that feel like the risk of investing in a low-income community for housing of this type is too risky, or isn't the right risk profile for their investment capital, and that has led to a lot of low to moderate income communities around the country, sort of being overlooked for a number of decades. And I think what we're really committed to is finding communities that are worth investing in, that represent both good places to invest in from a financial perspective and kind of a risk return perspective, but also from an impact and community building perspective. So we invest in low to moderate income communities around the country, and most of those, by the way, are BIPOC communities, so communities of color. And what we found, and we'll get to this hopefully later, but I think what we found in those communities is that there's sort of a talent arbitrage because they've been overlooked by capital for so long. There's some really fantastic developers and other kind of community stakeholders that are part of that ecosystem that are very institutionally underwritable from a real estate investment perspective, and represent a really great kind of investment arbitrage opportunity for us. I would say the other, as one of the other big differentiators in our strategy is that we do work with developer partners that are local to their community. These are by and large women and or BIPOC-led development firms. They are building in their home neighborhoods for the most part, and building with the full sort of grassroots support of that local community. That's a very different flavor of development and real estate investing than you typically find. These are projects that the community embraces. These are projects that are addressing real challenges, real gaps, real needs in those communities. We are really focused on financial innovation, and I think one reason we've had as much success as we have is that we've introduced a lot of financial innovation into our capital stacks at the project level, where when we're investing in a project, we're typically benefiting along with the developer and the local community from a series of state and local government grants or incentives that could be tax increment financing, tax abatements, grants, et cetera, philanthropic money that will occasionally go in and fund services and things like that in that community around the real estate. And that I think has helped us, notwithstanding some of the kind of macro headwinds and challenges that we identified a minute ago, that's sort of allowed us and put us in a position to be able to continue to invest in these communities and deliver good projects. We've also, I think, been innovative at the fund level where we sit. We have a 2-tranche capital structure in our current fund, which is basically recognizing that some of our investors need market rate returns and are less focused on the impact or the community benefits. But we have lots of other investors that are more focused on the community benefits and less yield sensitive, happy to take a little bit of a discount on the financial side in order to guarantee the access and availability of affordable housing and other services in these communities. And so we've basically been able to create a structure where we sort of blend those two capital types into the same fund, and that effectively blends down the aggregate cost of capital to the projects that we're investing in to a point where we can take a project that would normally only pencil at none of the units at an affordable price point to something where a majority to all of the units are at that kind of workforce attainable or affordable price point. So we think that's pretty innovative and pretty impactful. We also fund and deliver and facilitate a lot of wraparound services into our projects. We are in most cases, we're developing and investing in kind of commercial districts where housing sits on top of a retail or commercial space. And we're really intentional with our developer partners about activating that space to address needs in the community. So we have great examples in the book about, from co-op grocery stores and food deserts, preventative healthcare services and medical services deserts, workforce training facilities, financial services, et cetera, et cetera. So we take that really, really seriously, and we think that that's impactful above and beyond just the housing component that sits on top of that. We also work with nonprofits and social enterprises to give them space in our projects, allow them to program for the benefit of the community using the real estate that we've built in that community. And then we also are really serious about providing wraparound services to that community. And our developers are very good at that. They come with ideas, we come with ideas, and we find ways to fund and capitalize those services. Service navigation, workforce training, again, financial literacy, homeownership 101, just to name a few examples. And then I guess if somebody wants to put the slide up, what I would end with on this piece is just, if you can skip to the next slide. Sorry, I may have missed that slide earlier. So we do have an impact measurement framework, I think similar to Kate and her firms. We think about this on a pre-investment basis and a post-investment basis. Pre-investment, we're thinking very intentionally, again, in concert with our developer partners and the local community about, what are the needs of that community? And we have a very data-driven approach to this, but we basically scrape data from a couple dozen, different administrative data sites or, data sets that give us a sense or a snapshot in time of how this community is looking from, a race and ethnicity perspective, socioeconomic perspective, affordability perspective, things like level of education in the home, healthcare statistics, et cetera. And that really informs a conversation with the local community about what the development program ought to be and what should go in, for example, to that ground floor space. And that community needs assessment has actually been the driver of some of those, the co-op grocery and the food desert, some of those other examples I gave a minute ago. It was being intentional and data-driven on the front end that actually resulted in that, kind of outsized impact in the development program, in the actual community. So we think that's really interesting and differentiated. The other thing that we do on the pre-investment side is we have something called an impact scorecard, which has something like 80 different fields that we use to kind of score a project in a very, again, kind of formulaic, objective, data-driven way to understand how well we think that project that's being proposed for our investment will address the needs of that community. And if that project scores high, then it will move through our impact underwriting alongside the financial and kind of real estate diligence and underwriting that we're doing in parallel. If that project doesn't score above a certain threshold, then we won't move on, even if it was the most amazing, deal in the world from a pure kind of real estate and investment perspective. So we really do take those two, components, the return, the financial return, and kind of the impact component seriously, and we run those analyses in parallel. So that's what we're doing with impact measurement on the front end of an investment. Post-investment, I won't spend much time because I think we're kind of similar to the framework that Kate outlined. We're basically, grounding our analysis in the United Nations Sustainable Development Goals, and for each of the goals and the sub-goals beneath them that we think we touch on and satisfy, we have a range of KPIs that are sort of responsive to those sub-SDGs. And we're very clear about how we report that to our investors and others in the community and how we track those KPIs. There's a data collection system that sits behind that, and it often involves working with our developer partners, our property managers to collect data through tenant surveys, things like that. But we really are interested from both a kind of social impact perspective, but also from an environmental sustainability perspective, understanding how our projects, our investments are, moving the needle in these communities, and very serious about reporting that out to our investors and other stakeholders. So I think that's the best practice. I think other groups are starting to do more of that. And I think what you guys have done with TAS and Sorenson Impact Institute is really remarkable. And we sort of want to be in that same tier of folks that take it that seriously.
Thank you, Jeremy. It's also great to learn that both organizations are involved in some very interesting work. For the next question, I'm curious to learn about how leading with impact has helped to drive your business models forward, despite the perceived difficulties. Kate, would you like to start us off?
Yeah, definitely. I think I often refer to it as the tension between profit and purpose. And I think that capital really comes on it is available in a spectrum, right? From philanthropy to the financial first, investment drivers. And quite frankly, I think that an impact lens and an impact perspective is the prudent approach to the deployment of all capital. And so one of the things that we have done is embedded in everything that we do across the entire value chain of capital raising and capital deployment, and the way that we manage our assets. And I think that it is absolutely essential for businesses from a risk management perspective, as well as from an ethical perspective, to be addressing these challenges. And some of the practical ways that we've done it is very similar to the way Jeremy described with the due diligence process. We have developed an Impact DD scorecard that evaluates the social and environmental context of the neighborhoods in which we are assessing new assets. We identify both risks and opportunities from an impact perspective. We identify whether there is any potential for harm to be created, and look at what mitigation strategies might be necessary or might be possible in order to avoid those potential harms. And we also start engaging with community and third sector organizations in the community prior to acquisition. So we actually start getting out into the community very, very, very early. We have a price per carbon. We're one of the only developers I'm aware of currently that price carbon into their pro formas at the time of acquisition. We have quite a high number that we've set, so it's $170 Canadian per ton that we put into our pro formas. We also priced in a green building construction budget, which is over and above our carbon budget. So we see carbon as a separate cost that has real financial materiality. And we also start to embed into our pro formas the delivery of below market commercial space or affordable rental in the case of condos or other ownership models that we're exploring. We look at shared equity programs and very unique structures to help more people get access to attainable housing. And so we embed that right from the very beginning, and we continue to iterate throughout the project lifecycle. We're currently working with you at the Sorenson Institute to look at impact hurdles and how we embed those into our capital structures and our carry. And so that's a really exciting area for us to consider how we align our purpose right from the get-go. And I think it's really important to highlight that our thesis is really holistic. And so we actually truly believe and feel that our impact measurement system will help to provide really tangible evidence of this, is that by creating vibrant places where people want to live and work, that we're actually and places that are more inclusive of diverse incomes, businesses that can host social services, small businesses, this actually underpins the value of the asset and the precinct in which it's situated. And so one of our strategies is not so much on the affordable residential side of things, but on affordable commercial. We are looking at light industrial, urban commercial sites, and looking at how we can actually bring community into these places that are currently dead zones in terms of pedestrian traffic or community facilities and services, and how we can actually bring life to these places. And so we see that these strategies are actually inherent to the value proposition of the fund. And we actually think that this approach creates opportunities for innovative value propositions as well. So we're exploring that these are not things that we've delivered yet, but we are exploring and actively trying to figure out how to create these investment opportunities. And we're looking at neighborhood income trusts in the Canadian context and how we can create retail product for local people in the neighborhoods to invest in assets in their own neighborhoods. We're looking at renter equity programs, and that can be underpinned by tenants that stay longer in the building because they're treated well and the rents are affordable, and we can actually create equity programs for them through that intentional approach. So there's lots of unique models that we're exploring to continue to capitalize on the impact strategy.
Thank you, Kate. Jeremy?
Yeah, I think Kate covered that really nicely, and I agree 100%. I mean, she hit on something that's really, I think, an interesting insight, and one that maybe isn't obvious unless you've been doing the work for a while. But there is a financial benefit and a financial rationale or motivation. I should say a rationale for investing in places that are sort of becoming healthy, more vibrant, revitalized places to live. I mean, obviously, we think about those communities and that transition from an impact perspective. We say that's a great thing, but I would argue that it's also a good thing for the financial bottom line, because what you get at the end of the day is you get much more engaged residents, a much stickier tenant base. People that want to stay in those units or stay in the commercial space that they're renting, because they're part of something that is healthy and vibrant. And I think that's a really good point. I would point to a couple of other, and I won't spend a lot of time on this, but just a couple of things that we've noticed in our work that I think really justifies the fact that we're leaning into the impact in the way that we are, and actually drives good financial and business outcomes. For one thing, I think capital is interested in in these types of opportunities. There are in some cases kind of a regulatory, at least in the U.S., a regulatory rationale or mandate that different investors have. Fannie Mae has different programs that prioritize investing in these kinds of communities. HUD certainly has a number of programs that invest, that prioritize or incentivize investing in these kinds of communities. I'll give you one example. On the HUD side, there are 40-year amortization fixed rate HUD loan products that you're eligible for if you're investing in these types of projects in the U.S. And if you think about sort of the financially accretive impact of having kind of a low fixed rate amortized over 40 years, from a cash flow perspective, it's massive. So there are things to think about on kind of the capital availability and attractiveness and the cost of capital side that we think are really interesting. We also think about renter demand, or sort of the renter profile in the country on a bell curve. And if you're really renting to the middle of that bell curve and not sort of focused on the tails as much, sort of on the luxury side or on the deeply affordable kind of low-income housing tax credit side, that's a much bigger renter pool, just if you look at the numbers of it. In fact, we've calculated that based on the pricing of our units on average, we're renting or targeting a 16% larger renter pool than if we were trying to go, if our units were priced at over 100% of the average median, the average income in a community. So we think that's good. That's good business. There's also very inelastic demand for this type of housing product. So people have to live in places. They have to live in places that ideally they can afford. Demand on the higher end of the income spectrum tends to fall off in a recession or a downturn, and you don't see that as often in kind of that middle market, demographic. And so that translates into higher occupancy rates in your projects and better, financial returns. Another just quick example is because folks tend to be happy in these communities, happy in these units, or businesses happy in their space, there's a lot less turnover. We've estimated across our now $1 billion portfolio, 5 to 10% lower turnover rates in our tenancy. And if you've been in commercial real estate very long, you'll find out that a big driver of OpEx is turnover costs, because tenants come and go, and then you've got to kind of update the units, and that's a big driver of OpEx. So if you can reduce the rate at which people are turning over, that translates into significant savings. The last thing I would just say is that the wraparound services that we provide and help to facilitate, make people again want to stay in place because they're benefiting from that. And I'll just give you one really quick example. We have started to roll out a product called a financial tech product called Isuzu, which lets renters sort of earn, through their on-time rent payments, basically earn credit history for their credit score, so that they can then qualify for home loan or whatever it is at some point. That's a pretty unique model, and we really applaud groups like Isuzu for thinking about that and innovating that. We've rolled that out as much across a bunch of our portfolio, and what that's led to is a 14-point on average credit score improvement for our tenants, with 23% of our tenants graduating to a higher credit tier in their credit score. So little things like that are good for them, but also make them want to stay in our units, and that effectively translates into better financial outcomes for us.
That is very interesting. Thank you again for sharing the great work that you're doing. In preparation of this webinar, we've asked both of you to prepare an example of how you engage in a community to implement the work you've developed. Could you please share this with us? I also see that we have a lot of participant questions. Let's try to keep the examples concise so that we have a chance to get to them. Jeremy, why don't we start with you?
Yeah, I think there's a slide maybe on this that we could show. So I just have two very quick case studies. This is 112 units that we just delivered in North Minneapolis, which is the kind of African-American neighborhood in Minneapolis. It's actually the neighborhood where a lot of the civil unrest and property casualty destruction was post George Floyd in Minneapolis. We worked with a sponsor, the gentleman pictured here, Tim Baylor, who is from that community. We call him the pillar of his community because he's about 6'8". He's a huge guy, both figuratively and literally the pillar of his community. He was committed to rebuilding his neighborhood post George Floyd. We invested in, as you can see there, sort of deeply affordable, deed restricted housing, but then also, essential worker housing effectively in this building. And this just delivered about 2 weeks ago. We went to the kind of ribbon cutting. And this is really sort of the first investment in this community in about 40 years. And the community really came out in numbers, and just you can't imagine how much they appreciate, capital markets believing in them and believing in their story. We've also put a credit institution, or a credit union, on the ground floor of that project. This is a banking services desert. So in addition to the affordable housing, there'll be a lot of financial services and literacy programs that are provided as a result of this. I have one other quick case study, and then I'll turn it over to Kate. This is our most recent investment. We just made this investment in Winston-Salem, North Carolina, with another African-American developer, extremely talented and qualified individual. This is 198 units, and we actually just yesterday I just got back from again the sort of ribbon cutting for this project. Where you can see we basically took a lot of folks that were living in this community and rehoused them. They were in very dilapidated, very sad, housing units, and we've rehoused them in brand new, beautiful, units, and kept their rents in place. So for some of these 2 bedrooms, these folks are paying about, I think it's about $450 to $500 a month, which is unheard of. And then there's lots of other new units for members of the workforce there. This is a historically redline community. It's a community that got cut up with a freeway in the 1950s, like so many of these African-American communities did, and really cut off from economic opportunity in the Winston-Salem area. And so a lot of this is sort of reconnecting this community through streetscape improvements and everything else to the economic opportunities that are on the other side of the freeway, literally, from the project. The last thing I'll just say about this is on the ground floor of the space, we put in something called the Maya Angelou Center for Preventive Healthcare Services in concert and partnership with Wake Forest University. This will provide preventative healthcare services to this community, which hasn't happened in some number of decades. So really, really proud about this investment as well.
Thank you, Jeremy. Kate?
Thank you. Quite quickly, I just want to highlight that we have two different models of affordability that we currently pursue across our portfolio. One is a rental affordability strategy, whereby the asset owner discounts the rent to at least 100% AMR, if not below, which then, through partnership with not-for-profit providers, housing providers, allows the ultimate renter households to access rent geared to income subsidies available through the city and province in Ontario. The second model that we look at is a shared equity model. And what this does is allows resident owners or the homeowners to put a lower down payment without the need for mortgage insurance premiums to increase through a shared equity program where other equity investors co-participate in that equity participation, and therefore reducing their carrying costs and also allowing them to access an ownership stake far earlier. We have a case study that I wanted to highlight, which is the Campbell. There are two really interesting components to this project. The first is through our community engagement. We identified that the existing library in the neighborhood was stretched way beyond capacity and not meeting the needs of the community. And so we had a first of its kind public-private partnership in which we collaborated with the city to build a new library for the neighborhood and have it housed at the Campbell. And secondly, through outreach to the local shelters, we identified a need for women-led households to graduate into housing and rent geared to income program. And we're able to provide 10 units of rent geared to income housing for those households, helping women to escape the shelter system. And finally, I just wanted to highlight how our impact measurement system functions in this particular case. So we have the theory of change, which identifies all of the actions that the business takes in order to deliver affordable housing units. And on the other side of it, the beneficiary outcomes, in which we will actually reach out to the residents to understand what their lived experience is in the units and if they're meeting their needs. And so I'll pause there so that we can take some questions.
Thank you so much for sharing your examples. So now we will go into the audience Q&A. And so I have a question for Jeremy. What is the range of equity returns for institutional investors from concessionary to non-concessionary in the affordable housing space today?
Yeah, so it's a great question. I would say the range is, full market rate, sort of risk adjusted, kind of commercial oriented return expectations on one end of the spectrum, and that's really where we are. We're a non-concessionary sort of investment strategy. We do, as I said, have a second tranche in our fund, which has sort of a slightly discounted return expectation to kind of facilitate and enhance the impact. But I want to be clear that, with some of these kind of state and local government incentives, low land basis, partnerships with local communities, and some of the other stuff that we and our developer partners have done, we are targeting market rate, returns. And then it goes down from there. Certainly, you can put, grant money into affordable housing, and that's needed in certain contexts. We've seen, different blended financing structures where foundations or others have put, grants or recoverable grants in, and that has actually unlocked kind of more market rate oriented capital because it's taken a lot of risk off the table. So that could be first loss, money, or it could be sort of unfunded credit enhancements on the balance sheet of the foundation. There's some really interesting models there. But yeah, I would say the full the full spectrum. LIHTC, the low-income housing tax credit, which is not something that we do much with, but other groups do. That's sort of another product category, if you will, and there's sort of a range of returns within that as well. So I would say full spectrum returns depending on where you want to be from a return perspective and what the specific opportunity is.
Thank you, Jeremy. And we have a question for Kate. What is the most impactful strategy for eliminating homelessness? Okay. Yeah, go ahead.
Thanks, Al. It's a really important question, and certainly homelessness is those experiencing homelessness are at the end of the spectrum, where housing spectrum, where the crisis needs to be addressed wherever possible. And I think that some of the housing strategies within the task portfolio tend to be farther along the spectrum for households that aren't directly experiencing homelessness at the moment. One of our employees, our net zero coordinator, Robert Rayner, is an incredible human who is doing a lot of work around homelessness right now. And he has been looking at what some of the barriers are for those experiencing homelessness to move into more stable housing, and identified that one of the major issues is staying in community. And so many people experiencing homelessness do form very, very strong community connections. And I think one of the best strategies that he's identified is to help those in that situation to maintain those community connections. So he's been doing some really innovative work around micro-housing communities, making use of, sort of underutilized parking lots and parking structures to create micro-housing communities that allow most people to stay in neighborhoods and eventually find some stability and transition into more permanent housing. For families who are at risk of homelessness, our shelter system tends to prioritize families, and then we do have our Red Gear to Income programs that have a lot of wraparound social services that help those families find some stability and move into housing as soon as possible.
Thank you, Kate. And I see that we are at time. I would like to thank you all for joining us, and I want to give a special thank you to each of our panelists. The video from this webinar and other assets will be shared via email and social media. We hope you will all join us for future virtual convenings from the Sorenson Impact Institute.